All right, guys, a very common question I get, especially in our community, is what's a multi-bagger? So a multi-bagger is a company that you buy and it goes up by many, many times. So for example, you buy a stock at 20, if it goes to 200, it's a 10-bagger. It went up 10 times. If it goes to 400, it's a 20-bagger. Very simple. Now the question I get is, tell me how! How do I find them? Well, guys, that's like saying, hey, how do I win the lottery? Well, it's not really like saying that. But the point is, understanding what a multi-bagger is essential to finding them. All right. There are two methods of value investing. One is the cigar butt approach. The net's kind of, hey, this is a crappy company, but people are mispricing the assets. Overall, we'll see some major jump. And this is the early Warren Buffett stuff. You know, he finds a company selling for $10 million that has $20 million in a stock portfolio in there, plus $10 million in real estate assets net, and it eventually triples. How long? 2 or 3 years. He sells it, he moves on. Okay. Or he acquires the company in full, sells off all the assets, distributes the money. He's all good. That's one way of doing value investing. Now, what makes that hard? You always have to be searching and searching and searching and searching. And to be honest with you, that's how I started with value investing. But the second method of value investing is what Charlie Munger kind of introduced to Warren Buffett later on. And that's basically the way of buying great companies at great prices with high returns on invested capital. Well, why are high returns on invested capital important? Well, guys, that's how you get the multi-baggers. That's how you get companies to compound on themselves. So we've all seen this chart of compounding, right? From here to here, it's like 5x. From here to here, it's like 10x. But overall, it's a 50x company. Well, how do you do that? Well, you buy a great company at a good price and let them grow and grow and grow. Reinvest the capital, reinvest the cash flow into more and more growth. As they do that, it's going to compound on itself. Look at a company like Amazon. Back at the low of 2001, Amazon hit what's equivalent today of 30 cents per share. It's currently at $100 per share. That is a 300x, even with Amazon being down 50% in the last year. How did they do that? They kept growing. They kept reinvesting. They kept going back and taking their cash, and instead of giving it as dividends, they put it right back into the company. A lot of people love dividends. Spoiler alert, so do I. However, I only want to see dividends from companies that have no other growth potentials, and it's hard for them to reinvest the capital back into the business for more growth. I realized this the big way through real estate. When I would buy a piece of real estate, I used to think I'm buying a piece of real estate and I'm going to make management more efficient and blah, blah, blah. And then I realized something brilliant. If I put the money, the cash flow back into the property to upgrade kitchens and bathrooms, I would be taking the cash from the business and reinvesting it within itself and growing at 15 or 20% growth rates. So I took an investment that was already making 15% and took the extra cash flow and reinvested it at a much higher rate. That is the joys of compounding. That is what makes multi-baggers. And if you can find great companies at good prices and ride them out for a long period of time, that's what happens. This example is the one I always give, and I know it can become a little repetitive, but it's so important because I learned this lesson the hard way. Microsoft 11 years ago, I bought for around $20 or $22 a share. At 60, I sold it, saying, it's overpriced right now, I'll wait for a better time. It went to $350. Now it's at $240 per share. And guess what? I don't think it's worth $240. But what I do think it's worth? $150 to $180. So I sold it at 60. And instead of letting it compound, I lost out on 60%, 70% of the value just by saying, even though if I'd been smart, I would have said, wait a second. This is a company that reinvests in itself at much higher rates of return with a high gross margin, high bottom line margin, and a high ROIC. Why would I ever sell that if I bought it for a good price? Because it's impossible to guess. Look at Charlie Munger. He owns Costco. Costco is massively overpriced today, but he's not in the game of jumping in and out of investments. He's in the game of saying, I'm just going to let it ride. Because by the time it does finally hit its level where it might pull back, it might have already doubled and tripled from that previous value. On our software, we have our 8-pillar search. And one of our 8 pillars is 5-year ROIC. That's my main focus. I want to find a high ROIC that can compound on itself. Obviously, I need to sell for a reasonable price. And I also want reasonable debt. So to me, those are the four main metrics that matter for a multi-bagger, because I want them to be able to compound on themselves, sell for a reasonable rate, multiple of earnings and free cash flow, and finally, have reasonable debt so that if the market does take a step back in terms of the economy, they're not wiped out, because you can't recover from a 100% wipeout. So if I click here, I want this, 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 and this. It's my 5-year PE, 5-year ROIC, long-term liabilities divided by 5-year free cash flow, and the 5-year free cash flow multiple. I hit go, boom. All these companies I can go look at. This is my start. Are all of these going to be multi-baggers? Absolutely not. Your next step is to then go research. I mean, there's a couple hundred stocks here, and I guarantee in this level, there are multi-baggers here somewhere. Where? I don't know, but that's the joy of investing. That's the art of investing. Joining this community at everythingmoney.com will allow you to sit in there and talk to people about what has a lot of potential. By the way, T. Rowe Price is a company that I like. Not at this price, but it's a company that, look at this compounding over years. If you bought it back in 2000 at the peak of the bubble, $17 a share, it's still a 6-bagger. At this level, 7-bagger. That's what's important to look at. And guess what? I'm quite convinced that T. Rowe Price, if bought for a reasonable price, will be a company that keeps growing. Why? Look at their business model. It's a 401k business. Every quarter, every paycheck, people put money automatically into their accounts. So you're going to sit there and you're probably watching because you want the next Tesla, the next crypto. Guys, there are going to be far more multi-baggers you're going to find by doing this process than hoping to find the one hype company that has shattered all records. And as much as I like Elon Musk and Tesla as a car, it's an overpriced company. But if you bought it years ago, you'd had a multi-bagger. And I would have been wrong by saying, oh, it's overpriced years ago. But my goal is to buy great companies at reasonable prices with high rates of return and reasonable debt. If I can do that and let it ride for a long period of time, the problem is most people want the 10-bagger in 2 years. Guys, don't. You'd rather own a company for a long period of time that builds on itself. All right, guys, thanks very much. Do me a favor, subscribe to the channel. And if you're interested in the software and how it can help you find multi-baggers, go to everythingmoney.com. Thanks very much. Take care. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?